welcome back to Wealth Webinar. Today we're going to talk about how your dollars, your money, can work for you in two different ways. We've got some unique case studies we're going to talk about. We're going to get into a lot of things, but the thing I want to explain is you got to stop chasing returns. You know, I mentioned it in that video. Remember I said, you greedy beeps, but I wasn't referring to you guys. I was referring to everybody else. Just kidding. We got to stop chasing returns. When we chase returns, we run the risk of losing all of it. We put ourselves in harm's way. We also put ourselves in stress's way. Because how do you all feel? Like recently, right? If you've been watching the markets, you've had a lot of turbulence in the markets. They're going up, up, up. You have a big day, then all of a sudden it just crashes. Just so you all know, these are very telltale signs of what happens right before a recession. Like if you look at any other period right before the recession, more volatility. You have a lot of uncertainty. You have a lot of people that are scared. I mean, the volatility indexes have been higher than normal. So all these things are just telltale signs. So what I'm trying to say is you should not chase returns, because building wealth is not about chasing returns. If you think you can save your way to wealth, number one, you're wrong. If you think you can earn your way to wealth just because you're chasing high returns, you're more than likely a gambler. You might need some help, and you're probably not going to hit your goals of where you want to be on the wealth by chasing returns. But you know how you do hit your wealth goals? Consistent, persistent action, making your money work for you. So today I figured, instead of just showing you how to make your money work, I'm going to give you some real life examples of some things I recently did because I had to solve two problems. And I had $1, not really $1, but I had $1 that I wanted to solve two different problems. So if you've got money and you want your money to solve one problem, that's easy. But if you want your money to solve two different problems, you got to understand strategy. And you got to understand how to do that, which is what I want to do today. What you've got to get good at, folks, is sending your money out to work every single day. Because listen, like, let's face it, like, what do we do every single day? We get up, some of us way too early. Today was 4:45 in the morning. I normally go to the pool, as I was mentioning off, and I swim, okay? But I had to get up earlier because I had legal documents to read, and you know what? There's just not enough time in the day. So that's what we do every day, except for Saturdays and Sundays. We get up and we go to work. And we work hard and we get results. We solve people's problems. We make money for the company and for ourselves. If you do that your entire life, you will burn out. You will break down. If you're in the construction or the trades, your body will fail you eventually. Because the thing we all need to get better at, all of us, myself included, is making our money work harder than we work. You see, we've got it backwards. We've been taught backwards. We've been taught, work hard, hustle, go, work overtime, do this, do that. And then what have we been taught to do with our money? Just put it away and leave it sit. Just put it into 401k and leave it sit. Just put it in this thing and just leave it sit, right? Hope and pray. Chase the returns. Oh, look at the past performance on this mutual fund or this investment's been great. Hoping and praying. I'm not saying there's anything wrong with that, but there's simply a better way. Your money can do double duty, but you've got to focus and pay attention to making sure your money's out working. I'll bet you any money, if I were to poll and go through all 131 of you, I bet you a bunch of you have lazy money just sitting there. You got lazy money just sitting in your cash value life insurance. You got lazy money sitting in your self-directed IRA or your Roth IRA or your 401k, just lazy money sitting all over the place. And when asked, hey, how come you're not making that money go to work? You're like, I don't know. I always say this, and I said it in that last video, if you ask people like why they invest in their 401k, they're like, oh, I don't know. I was told to do it. It's a whole bunch of I don't knows. We'll start putting I know why I do things. Why don't we start with that? Oh, I know why I do that. I do that because of this goal I'm trying to solve. I do that because I have this goal. And what is your goal? Some of you are just like, I want to retire someday, Chris. Great. When is someday? Because someday to me is like, well, the day you die is good, right? Might as well start then. What is someday to you? Define your goals. If you've got retirement as your number one goal, what age are you going to retire? What month are you going to retire? What day of that month are you going to retire? In the morning on that day, what is it going to feel like? What is it going to look like? What are you going to do your first day in retirement where you no longer have to go to work? Draw it out, write it out, have Chat GPT literally listen to you talk and give me a formula with art and graphics and pretty pictures of what does your perfect day look like? Because you know what? If that's your perfect day, the day you retire, you better freaking know what it looks like. And you better know how you're going to get there. And the only way you're going to get there is by making your money work for you. And that is the single sole thing we're going to talk about. But we're going to add a little level. And I'm going to do this because I'm just going to teach you a personal thing that I just did. And we got Michael on here, okay, and we'll get into Michael in a little while, but we're going to talk about what I just did because I didn't have just one problem I wanted to solve. I had two. Number one, I wanted my money working for me. And I wanted to make a spread. Why? Because I am my own bank. You know, when people ask me, so what do you do? Well, I bank. That's what I do. I took control of my money and I became the bank. That's what I do. Well, what does that mean? Well, you see that car out there? Yeah. That car is funded with my own private banking system. Every payment for that car is paid back to me. That's what I do. So when I start doing that, I have money in my private banking system that needs to go to work. And I got to find ways to do that. And you know what I like doing? I like doing what banks do. You know, and you all know how a bank works, right? You go into a bank and you make a deposit. You take your money and you put it into a traditional bank, savings, checking, I don't care. You put your money in there and what is it that you're hoping to get? Hopefully you're all saying, I hope I get some interest. Right. You're hoping you get a little interest, right? So the bank gives you 3%, 4%, maybe 5% interest. Now, what does the bank do with that money? They don't put it in the vault with your name on it. I promise you. They take your money and your money goes to work for them. And they lend your money out at a higher interest rate. So if they pay you 3, they lend your money out at 6, they make a 3-point spread. Your money is now working for them. That's right. Your money is now working for them. Now just imagine this, your key person, okay, your key employee, your key person that works in your company. Imagine if every day they showed up to your place of business, they did 1 hour of work, and then they went to work for somebody else. And you just were like, cool, I'm good with that. And you were paying them still, but they went to work for somebody else. Would you feel good about that? How many of you would feel okay that if your key person, or any employee for that matter, came to work and they spent 1 hour working for you and then they went to work for somebody else, but you were still paying the bill? It sounds stupid, right? It sounds idiotic. But like, okay, that's what you do with your money every single day. You ever think about that? You take your money that you worked really hard for. This is your employee, your key employee. It's your money. This is it. It's your tool. And you put it in the bank and the bank pays you interest on that money. Then the bank takes that money and makes it go to work for them. The whole rest of the time you leave it there and they make 400 to 1,300% more than you do. And you're just cool with that. You're just like, well, that's just how it is. Bullshit. That's not how it is for me. That's not how it is for Stephen. That's not how it is for Jordan. That's not how it is for Shauna. No, 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 no. That spread that we used to let the bank get, no, we get that now. And I'm going to show you how I solved that problem. But you know, I had another problem. It's called the IRS. You all know Uncle Sam, right? He knocks on your door maybe once, twice a year. As some of you, if you're self-employed, once a quarter. It's called an estimated tax payment. You have taxes that are due every single year. Well, you know what? I don't like paying taxes. No one does. And you know what? In the United States, it's pretty unique. It's our option to pay taxes. Did you know that? In the tax code, it is our option to pay taxes. Now, please don't take this wrong. Consult with your CPA or tax professional. I'm not saying avoid taxes. I'm not saying try to hide money from taxes. There are legal ways for you not to pay taxes. Well, we're going to talk about that because that was my problem. I wanted a legal way, black and white, legal. And I wanted my CPA to say, oh yeah, that's absolutely something you should do. I wanted my money to work for me in a way that got me tax deductions. But I didn't want to give up control of that money. I wanted that money to still continue working for me, but I didn't want to pay tax on it. Cool? So those are the two problems we're going to solve today. And I'm going to show you how to do that by kind of giving you two different job descriptions, okay? And I want you to pay attention. Matter of fact, how about we do it this way? Because I know some of you like visuals. So I'm just going to draw this. So here's what we're going to do. All right, so first thing, we're going to talk about two jobs. The first job, we're going to talk about cleaning your sewer pipes out. No, I'm just kidding. We're going to talk the first job, and this is, we want your money to have a safe place, a safe storage for where your money can go, okay? This place has to have liquidity because this is your opportunity fund. This is your emergency fund, whatever you want to call it, your op fund, your emergency fund. I once heard somebody call it a bus fund, and I said, why do you call it a bus fund? And they said, well, if I get hit by a bus, this is the money that we're going to use. I'm like, all right, whatever, however you justify it. So when we talk about job number one for your money, I want you to think about your money being in a guaranteed place. Now, where can you get a guarantee on your money? So we've got all these different things here. So your policy, okay? So we're just going to go here. Your specially designed whole life insurance policy can be that storage in that warehouse where your money rests. This is not where your money goes to stay. I want to preface that. Job number one of your money is not to put your money here and leave it here. The returns are too low. And all of you, all those places you said, CDs, what's the best you're getting in CDs right now? 3-4%. Fixed annuities, Nighthead is probably the top fixed guaranteed annuity right now, and they're at like 5.7% for a 5-year lock. Okay, then you got bank accounts, right? CDs, or sorry, savings or checking. Someone mentioned T-bills or treasuries. You can get 3 to maybe 4.5% on them. I haven't looked. Yeah, right? So those are all the places, but all we need to do is find a place to store our money where we can get paid an interest rate. And let's put that down again, a guaranteed interest rate on that money. But the number one thing I want to preface is we need to have liquidity here. That's what we want for job number one. Now, job number two is a little bit more fun to talk about. And I'm just using the whole life because first off, let's just kind of go through why. Because some of you are like, well, why did you write whole life? Why aren't you putting cash? Why aren't you using the T-bills? Why aren't you using the CDs? Well, because whole life provides the liquidity I want. Whole life gives me a guaranteed interest rate. Every whole life insurance company or life insurance company we deal with are mutually owned, so they all pay dividends, and they pay dividends every single year. And I'm getting over 5% dividend crediting rate with any of those companies. It grows tax-free. Remember I mentioned how much I loved Uncle Sam? Grows tax-free, so that's a pretty cool thing. And hey, listen, I love my family. So if I die, my family gets a big death benefit. Fair enough? It's just better than the alternatives. So that's why we're using that. But now, job number two for your money is we need to find a place to deploy our money. And we need to deploy our money into opportunities. So real quick, help me out here, folks. Talk to me a little bit about opportunities. What kind of opportunities are you all seeing out there? What are some of what would you say the number one opportunity to build wealth would be? But the number one place to build wealth is through your own debts and expenses. Because if you have credit cards, folks, your credit cards are dinging you out at over 20%. Okay, that's the national average. It's over 20%. So I don't know any real estate deals, Robert or anybody else, rentals we're referring to, that pay 20% return with zero risk. Does anyone know any investment that you can put money in or any opportunity? Let's take away investment. Any opportunity that you can put your money in where you can get a 20+% return guaranteed. When you have debts and you just keep making those payments on those debts, that money's leaving your family forever at a very high velocity. And when that money leaves your family, it never comes back unless you learn how the infinite banking concept works. So I'm just going to put a couple of the things I saw. I saw debt. I saw real estate, which is a great answer because we're not making any more of that stuff. Let's see. Diana, we'll talk about that in a second. Mexican cartel imports. All right, let's go with that. So we got investment opportunity, Mexican cartel. What is that? Imports or exports? Imports. All right, great. Wonder what line of work you're in. Anyway. We'll get back to that one. What else do we got? Tax liens. Okay, that's kind of real estate. I'm going to put that there. Loaning money to other people. That we're going to keep that in real estate. But yeah, we'll just put loaning. Okay, lending. Okay, you can do that. These are all great. And then we got real estate. All right, perfect. So all of these things that we just put in opportunities, what you can do is if you do job number one correctly, if you put your money in the right place, job number one can make job number two way better. Okay, because I don't care if it's debt, real estate, Mexican cartel imports, lending. If you take money from your specially designed whole life and you put it into Mexican cartel imports, whatever, you get to make money on whatever the cartel pays you before they kill you. But nonetheless, I mean, hey, What a ride. You're getting paid interest and dividends on the money, plus you're making the returns of lending, the returns of real estate, the returns that you used to give away to your debts. You get to make both because the interest and dividends is still paid on your cash value inside the whole life, even after you take money out. Now, here's the important thing. There is a cost. We're going to get into this in a second. There is a cost. When you borrow money from your life insurance policy, we only do specially designed whole lives. And Stephen, make sure if we got to come back to Diana, hers about that IUL one, we'll come back to that. But anyway, there is a cost. And I don't care if it's an IUL or a whole life. There's a cost for the capital. When you borrow money from the insurance company, okay, which is what you're doing, because you've got money in your cash value. But when you take a loan from your policy, and any of the policies we design, I can't speak for all of them, when you take a loan from your policy, you're not taking your money. The insurance company is lending you money from their general account. They are literally doing a line item entry, taking it from your death benefit. So effectively, you're borrowing part of your death benefit up to the amount of your cash value. So if you had $10,000 in cash value, and you took, I'm just going to keep this simple, $10,000 out to invest in the Mexican cartel imports, okay? 10 grand did not leave your whole life policy. 10 grand is still in your whole life, earning a dividend crediting rate uninterrupted, while you get to make the returns of lending, real estate, debt, whatever your opportunity is. But the insurance company, because they're lending you money from their general account and using your $10,000 cash value as collateral, what they're basically doing is they're charging you an interest rate. But the cool part about borrowing from the insurance company is it's a loan that technically never needs to be paid back because all they did is advance part of your death benefit. Now, we don't teach not paying the loans back, but I do want to preface that the pressure's off. Because if something bad happened, you broke your leg, you're out of work for 6 months, you lose your job, and you can't make the payments back to the insurance company, it's okay. They're not going to ask you for it. The interest will still keep getting charged. But here's the thing. Remember I mentioned how a bank makes money? They pay you 3, they charge you 6, they make a spread. Well, when we become the bank, we flip that. Because we're the bank, we make interest and dividends on the money at a higher rate than our cost of capital is, so we make the spread. But we make the spread twice. We make money on our original cash value, and then whatever the cost is, let's use 5%. Actually, let me round up high. Let's say 6% interest. Most of them are under that. Let's say 6% interest is your cost, but let's just say you're lending the money out at 12. So 12 minus 6 is what? You're still making a spread of 6 points. And still earning interest and dividends on your full amount. Your money's making money for you twice. I wanted to preface this and take some time because that's the basis. That is the basis of every single thing we teach. Now, in good times, in bad times, it does not matter. Okay? Your money continues to work for you. Your money continues to keep working for you. Now, how many of you on here have children? Put I in the chat. How many of you have children? Okay, we got a bunch of you that have children. How many of you are teaching your kids about money? Put a $sign if you're teaching your children about money. Great. See, I take this really serious. I put my money where my mouth is. Me and Hannah wrote a children's book called The Companion. This is a shameless plug, so you can call it whatever it is. This children's book is written because there was a book when I was a child my mom always read me. It was called The Giving Tree. It was the one children's book that I always remembered. And when I became a father, that was the only book I wanted to read my daughter. And then I found that that author had a bunch of other books like The Missing Piece. And then there's a couple of books in Shel Silverstein's. But let's just talk about The Giving Tree. What The Giving Tree taught in a simple children's book, I think changed people's lives. How many of you read The Giving Tree? Very powerful book. So that was the motivation when we wrote The Companion. But we spun The Companion to teach kids not just about money, but about being good people, about being good stewards of life and good stewards of money. And I just want to read this one thing because I think it's very relative to now. So the whole book is all illustrated by Sam Welty. He did a great job. But in this book, like the others, like The Missing Piece, there are little like rhymes. There's little sing-alongs that you do. And I want to read this one to you because in today's times where the economy is cooling down, the markets are getting tough, bad deals are coming out left, right, and center. Like people are struggling with debts. People are struggling to keep, their standard of living. This one says, hand in hand we walk once more, with lessons learned and faith restored. The road ahead may rise and fall, but I'll be at your side through it all. The only reason I say that is life is never going to be perfect every day. Life is going to have ups and downs. It's better to teach our children that life is not always going to be good. It's not always going to be, rainbows and unicorns. And it's also important to teach your children to have faith, to be kind, and to nurture those around them. So folks, like, that's just one little story. If any of you have children and you have not picked up the book, please, please, please grab a copy at Amazon. The book is called The Companion. I'll just put it up here, and then we're going to get back into this. But I just felt like this is super important right now to kind of get this out there for kids, because I haven't talked about it in a while, and our kids need to learn what we're learning. All right, let's get back into this. One of the things I wanted to do, it's a magic disappearing trick. Magic disappearing. Yes, it is a great Christmas present. And actually, yeah, that's great. We got Thanksgiving coming up next week. One of my favorite breaks from the chaos is Thanksgiving. And then we got Christmas. So grab a copy of The Companion for Christmas. But all right, let's get into this. So now that, Stephen, real quick, back in the, I don't want to run over anything, but in the chat, was there anything that you want to hit on? Is there anything that we need to cover before I move on to this part?
I haven't seen any specific questions.
Warren says, does the debt that pays the best returns include your mortgage? The mortgage is one of your worst debts. It just doesn't appear it from the surface. It's kind of like that friend that every time you're around them, they make it seem like they're your best friend, but then when you leave, they're talking shit about you to everybody else, right? That's your mortgage. Your mortgage is talking shit to you because your mortgage is saying, oh no, I'm your buddy. I'm only 3%. Like, don't worry about me. But then you read in the fine print, after you kind of get off that high of like, I got a super low mortgage. You're reading the fine print, and the fine print says 80% of your payment is going to interest. And you're like, wait. And if you average it out for any other period of time than 30 years or whatever your term is, you will find that you are not paying 3 or 4 or whatever your rate is. You're paying way more. That's not a good friend. So yes, I love that question, Warren, about your mortgage, but mortgages are tricky because they're an amortized loan. So a mortgage, let me just show, can I just show you something real quick? And this is more for Warren. Let's say you wanted to pay off your mortgage. Let's say you had a mortgage that was 4% interest, 30 years, okay? You're 5 years in, so you got 25 years left, 4%, and your payment's $1,500. Just making stuff up here, all right? So if you came in, and let's say you owe $300,000. Let's say you came in and you're like, hey, I'm going to dump a bunch of money on my mortgage. I'm going to take this $100,000 that I have, and I'm going to pay down my mortgage. So now you owe $200 on your mortgage, but did your monthly payment change? No. Your monthly payment is still $1,500. Unless you recast your mortgage, which some banks do, some don't, but just imagine having to recast every single time you made a principal payment. It's kind of a pain in the butt. So the difficult thing about a mortgage, unlike a credit card, so if we did this with a credit card, let's just do this. Let's say you had a credit card that you were paying $1,500 a month on. You owed $300,000 on that credit card. You got one of those Amex Blacks, and they're charging you 20%. Watch this. So if we took that same $100 payment, we paid down the credit card. Now you owe $200,000 on that credit card, but now your monthly payment is no longer $1,500. Your monthly payment's probably now more like $900. So we just picked up $600 of cash flow in that transaction. And if we did what we teach, if you became the bank, this is your bank up here, your policy, and we took the 600. So let's just say you did it this way. You took 100,000 as a loan from your policy. You paid down your credit card. It freed up $600 a month in cash flow. And then you took that $600 a month and you put that back into the policy. You're recapturing money, which means every month you got $600 building up every month in this policy that gets to be used and redeployed again and again, and round we go. And then that's not 600, then it's 700 and 800, 900. Eventually you pay that credit card off and it's 1,500. Now I used a big example because I was matching that. This is way easier to digest to paying off than your mortgage. When we run our modeling, our debt blaster modeling to pay off people's debts, the mortgage is often, almost always last because it's the least efficient debt to pay off. It's definitely the best one to pay off because you're getting crushed, but it's the least efficient way to pay off debt. Now, some of you are like, well, that's all I owe is my mortgage. Great. Well, we have different strategies for that. I'm just trying to explain that. What else we got,
Yeah.
Steven?
And if you're like 10, 15 years into it and you've already paid a lot of that interest, it might make sense at that point to not put a bunch of money towards the mortgage, instead invest it, make the spread. So there's different strategies depending on what you're trying to accomplish. But this next question kind of goes into that, Chris.
Okay.
And this is a common kind of misconception on what we do with these policies. So I'm going to read it out loud. So George said, how much money would a person need to front dump into a policy and then need an amount to put in yearly to be able to retire in 10 years, targeting for 50,000 a year, for example, of supplemental income?
Yeah, so George, that's a great question and one that we can solve, but not one that I can solve just by giving you a magic number. Oh, well, you got to put this much in. We have software that does this. It's called the Gains Projector. It's part of the Vault software. We'll put the link up in there. You guys can try it out and test out the Vault. But that is just reverse engineering of that goal. That's all that is. So first we start with your goal. You want 50,000 supplemental income, and let's just make that income tax free. So to get to that, and then we take your time horizon, and then we figure out, okay, how much money's got to be put away in order to do that. Now, I'm going to tell you in a short time horizon, the policy is not going to be the most efficient way to hit your goal unless we used the cash. So let me give you an example. So let's switch this up a little bit, okay? Sorry, my drawing's a little messy here, but let's just use this example, and then I really got to get in because I want to get to Michael's part, and I got to tell you what I just did so that we can frame this thing up. So let's say you want to retire. What were the numbers again, Stephen? He wanted to retire in how many years?
Say 10 years.
10 years, wants to retire in 10 years. So we got, actually, sorry, I thought it said 5. 10 years, $50,000 a year. Okay, that's how much money you would need, George. And what other things? Supplemental, so let's say that's tax-free income, retire 10 years. Now, if we just, all we did, George, is if we just said, all right, well, if I came up with a number, all right, George, to retire 50,000 a year, you got to put $300,000 in, and then each year put 50K, you know, and then in 10 years, you're gonna have enough money to retire. You know what I just did? Lied to you. Just like, that's how IULs are sold. Please don't make me go down that path. That's why Kyle Busch and his wife Samantha are suing the IUL company and the agent, because that's what they did. They didn't think through a strategy, and they didn't think through how things work. Now, here would be the right way to do this. I want to retire with $50,000 a year in 10 years. Great. I've got 300,000 bucks, you know, that I could do something with, and about $50,000 a year to save. Now, George, I'm just making numbers up. I'm just picking them straight out of the sky. Let's say, George, you also had debts. Okay. So let's say you had debts of $100,000. And this can be all sorts of debts. It can be your mortgage, it could be your car, it could be your credit cards, lines of credit. Let's just say you had debts of $100,000, and that $100,000 is costing you $2,000 a month with an average interest rate of 12%. I'm just using those numbers. So now, let's say once you put the 300 in here, now let's just say you're with one of the companies that we work with that pays 5.9% dividend crediting rate. So this is your dividend crediting rate you're earning. That doesn't really matter for what we're going to talk about. It matters, but it's not going to be the first thing. If we took 100 grand out of the policy and we paid these debts off, and we took the $2,000 a month that we just freed up, which is roughly 12% interest, and we put that back into your policy. So we got $2,000 a month going in. That's $24,000 a year. It would only take you a few years to recapture all 100,000 that you laid out to pay this debt off, because you're the bank. You got all that money back, and all the while your money continued, your full 300 or whatever your cash value is, continued to earn 5.9. But then let's just say after you got through debts, let's say you did some other deals, okay? Let's say you found yourself a good mineral deal to do, mineral rights deal that was going to pay you 10% interest on your money. So let's say you took another 100, or you put, I'll just keep this simple. You took 200 out, you put it in this mineral rights, okay? That paid you 10%. Whatever the interest, that would give you 24,000 back every single year. Hopefully I'm doing the math right. I'm doing this quick. So now all of a sudden you got the 2,000 going back into your policy, because that's money you used to give away on your debts. Now you got another $24,000 a year going back into your policy. All the while, all of your money, including the recaptured money, is earning 5.9. So you got to make money twice. Now, if we did this for 10 years and we just kept this original 300 plus the 50 going around this circle for a period of 10 years, then after the 10th year, we shut that stuff down. And all we then did is start taking 50 grand from the policy. I bet you'd hit your goal super quick. That makes sense? And I have videos that show that. You see, a lot of people just want to put money somewhere, leave it sit, and then hope and pray that they're going to be able to retire in 10 years. George, that is not the way to do it. That's what I mentioned in the beginning. That's what I just showed you. Your money needs to continuously work for you in a strategic way. And that's what we're going to get into right now, strategy. All right, so I'm going to make this personal. Is that okay? Everybody okay if I make this about me for a second? Because I'm going to show you what I just did, and then you guys can relate this to how this might work for you. Okay, so right now, I am hoarding cash, but I don't hoard cash. I hoard cash value. So I've got a whole bunch of cash value. And I'm not going out and lending money right now. Okay, I do small deals here and there, but I'm really not doing anything. I'm hoarding cash. And I'm hoarding cash right now because I know there's going to be a big opportunity. And because I've also been investing heavily into my own companies, starting an RIA, launching the Vault software, which was hundreds of thousands of dollars, getting ready to undergo a complete AI implementation into all of our workflows and our business. Like, we're literally building a company for the future. But that future is today. We're building it right here and right now. You'll hear more about that in the coming months. But I'm investing in those things. So therefore, I need to keep cash. So let's just say, I'm not going to give you the full amount, but let's just say I got $300,000 sitting in my policies in cash value. Now, this is in my, just so you all know, this is my specially designed whole life insurance policies, because this isn't just one. So let's just use that number. That's not the real number, but let's just use that. One of the things I needed to do is in 2024, I had taxes that I was going to owe. So when we did our tax planning, we were thinking, what are the things we can put money into that will reduce my taxes? So we have a private foundation. So every quarter, we put money into the private foundation based on a schedule. And then I have a SEP IRA. So every year I take money into mine and my wife's. I put money into a self-directed SEP IRA, which I'll cover in just a second. And then also I look for other opportunities where I can get tax deductions. So I met this gentleman, Troy, from this company, Eckard, okay? And this company, Eckard, is in the oil business. Now, this administration, can I just ask all of you a favor? I don't, this isn't political. Is this administration, the Trump administration, pro-oil or against oil? Just checking for a friend. Yeah, very pro-oil, right? Very pro-fracking, pro-oil, pro-drilling, all these things. Also pro-tax savings. So what they did, and some people would say, oh, this is just for the wealthy. No, it's not, but okay, whatever. We'll chalk it up. They increased the bonus depreciation, okay? The bonus depreciation. So now we got better tax deductibility. So what I wanted to do, all right, so I had this money sitting, but I knew that if I didn't do something into an investment that would give me tax savings, then I was going to just have to give money away to the government. So if you had money just sitting in cash because you were hoarding cash, but you knew if you did nothing, some of that money was just going to be paid to the government and gone forever. Would you do something? Yes. So I did. So what I did is I went to Eckard, okay? I went to Eckard, and here's what I found out. I found out that Eckard, and this is, just so you all know, this is not a commercial for Eckard. I'm not endorsing Eckard. I'm not telling you to invest with Eckard. I'm simply telling you this is what I did. All of you can do your own due diligence, meet with your financial advisors, meet with the financial advisors at PMC Wealth. They're phenomenal. I know they've been meeting with clients all day today, but you could get with them and you could get your own investment advice on what you should do. But this is me. Remember I said, is it okay if I talk about me? This is a recommendation from my CPA and a recommendation by me because I didn't want to pay the government money. So Eckard had a couple things. They had mineral deals. And mineral deals, what's really cool about them is they pay interest, or well, let's just put down, they pay income pretty much right away. So if you had a need for income, you could go into minerals. But they also have a bunch of different drilling programs. Now, you all said that this administration is pro-drilling and pro-oil. So that to me says for at least the next, what do we got? 3 years left, almost a little more than 3 years left. Like oil's the thing. Oil's definitely going to be a thing. So drilling gives me tax deductibility, which I'm not going to go into that because I just want to stay in my lane, but I needed tax deductions. And with 100% bonus depreciation, I knew I was going to get some good deductions here. I'll let Michael cover this in a second. But I took money, exactly $100,000, and I'm just going to draw it like this. Here's my whole life policies. Now, just so you all know, all my policies are connected to a CV line of credit. Think of a CV line of credit the exact same way you would a HELOC. A HELOC, a home equity line of credit, is when you have equity in your home and you want to get that money out of your walls. You want to extract the money from your home so you could do something productive with it. Well, when you have money in whole life policies, if you have a bunch of them, a CV, cash value line of credit can be really beneficial. So what a CV line of credit does is it allows me one checking account. Okay, I have one point of access. So we'll say POA, one point of access that accesses all 14 of my whole life policies. So I have one checkbook, one place to deposit money, one place to take money from that accesses all of my policies. Now, I'm not saying that a CV line of credit is right for you. As a matter of fact, if you have like 1, 2, 3 policies, it's not. It's not. The interest rate's higher than the insurance companies charge. You got to pay interest every single month where the insurance company charges the interest once a month. But I'm just saying, for the right person, it can work. So what I want to do here, folks, I want you to all understand that my scenario, I used the CV line of credit, which was using my personal banking system, my policies. But you could also use a HELOC because it would work for this. Okay? Fair enough? So just think, when you're thinking, oh, I don't have a CV line of credit, I don't have a policy. Okay, well then just pretend it's a HELOC. The thing's going to be the same. So what I did is I took $100,000, okay, from my policies. I took a loan from them and I put it into this drilling opportunity. Now, the sole problem I was solving here is I did not want to pay more in taxes. I needed tax deductions. This drilling opportunity, which Michael will talk about, gave me exactly what I wanted. But also, I didn't want to put money into something that I was going to lose money on. I wanted to put it with someone that I had a credibility, had a track history, and somebody that I knew was going to eventually give me my money back or give me a return on my money. I am very confident that I will receive a return on my money, and Michael will kind of support that. But I already went through it all. I talked to them. I felt good about this investment, to which you need to do your due diligence. But I did this. Let's just say this 100 grand was put to work just for taxes. But you see, here I created a problem. I really did. I created a problem because this 100,000 that I took from my whole life policy has a cost of capital, COC, cost of capital. Okay, just trying to write all this down. So let me show you this. My CV line of credit is 6%. So that means if I had $100,000, 6%, $6,000 would be my cost per year. Okay, divided by 12 is $500. So $500 per month. That's my drag. I didn't like that. I know I'm doing this for taxes, but I know that this drilling opportunity is not going to pay me any interest. It's not going to pay me a return for later. They got to drill it. They got to extract oil, and then I'll get a return on my money later. But I did this for taxes, but I cannot be losing $500 a month doing this. But in this case, I did, because there is no recapture. Does everybody understand what I'm saying? There's no recapture here. I can't extract an income from this drilling because I did the drilling for tax reasons. So what I then did is I went to Eckerd and I found out that they had a couple opportunities where I could make an income. Now there's the minerals, which we're going to talk about, but Eckerd back a while ago had a note that they offered, okay, on a building that they had, and they offered 10.5%. I think that's right, but Michael will confirm this. That's the beauty about having Michael come on. Michael, is that right? 10.5% was that note on the building?
Yeah, 10 and a quarter.
10 and a quarter, see? I knew somebody had to correct me. Semantics. So 10 and a quarter. All right, so now let's do the math. So now I had 100 grand into drilling, but I needed to support this $500 a month. So what I did is I said, how much money will it take at 10.25%? I'm just doing the math here, times 10.25%, 51.25. So what I'm saying is if I put $50,000 into this note at 10.25%, what I'm going to get is I'm going to get $51.25 a year, which is divided by 12, $427. That was going to be how much money I was going to get. So this is what I did. I reverse engineered how much money I needed to put into the note or the minerals. You could do it either way to support my cost. Now I just did this quickly. So it's probably 60 grand or something like that. Okay. Let's do this. We'll just see 60 grand times 10.25. I do this right. 60 grand times 10.25%. There we go. So it is 60 grand roughly. So you got to put 60,000 bucks into the note. Now I did not, in full transparency, I did.
So I'm just using this desk. I don't know.
In my case, I did 50, but let's just say we were solving for this goal. We need to cover $6,000. If I did 60, it would be 6,150. Now I didn't do the full 60. I did $50,000 because I had other investments that would have supported that cost. Okay. But I'm just showing you how to do this. Now with this, we got $6,150 that we just created a cash flow on this note. So I put 60 grand in this. It cash flows 512. Am I doing this right? Yeah, 512.50. So I take that 512.50, I recycle and recapture that over into my policy. And this is exactly what I'm doing into my CV line of credit every month. And here in this case, if you did 60, you made $12.50. Now that's not that much, is it? Some of you would be like, why would you do that? If it's costing you 500 and you're investing it in this at 60 grand and you're only making 512, well, because all of my money, every penny of this 300 grand in this example is earning, I'm probably making way more than this, but let's just say 7.2%, give or take, dividend crediting rate. I'm actually higher because my policies are old, but I'm still making this on all of this, but I just invested 160,000 of this. Do you see how I did this? And I solved two problems. I'm making a spread, number one. I'm actually making two spreads. So here I'm making a tiny little spread of $12.50, but that is covering this benefit, which is the drilling benefit, the tax benefit, which is big for me. Michael, I don't know if you're going to show that, but do you have a way to show like $100,000 at the highest tax bracket, what that would be in a tax savings?
I don't have a chart on me, but essentially from the day you write the check, assuming you're at the highest tax bracket of 37%, you're making 37% right when you write your check.
Okay.
So that's automatic. And the way we look at these investments are absent the tax deduction, it's first and foremost an investment, right? So you have to look at the asset class itself, realistically, based off of our due diligence and the areas that we buy, our average annualized return is 33%. But to basically answer your question, $100,000 unit, you're saving 37% right from the start.
So day one, my $100,000 that I put into this drilling, and Michael, please correct me if I get the math wrong. I'm just spewing out here. I didn't have any of this written down. I'm just giving the numbers. If I put 100 grand from my policy into that drilling, which I did, technically from day one, I just made $37,500.
And that's a gift. Folks, yeah, that's a gift from the IRS.
Yeah. So folks, I know a lot of people are like, you didn't actually make that. How did I not? Because that absolutely would have been paid to the IRS. So if I don't have to pay it to the IRS and I get to keep it, is there a difference? It's the same thing. So literally, I just made $37,500 plus that's a tax deduction. And we're going to come back to the drilling in just 1 second, because you notice how Michael very quickly said, this is an investment, Chris. It's not just the tax savings. You're going to make money. But no. Let's just pretend that I just discounted the fact that I think this is going to ever pay. Michael, let's just pretend that Chris Naugle thinks that Eckert is not going to pay me anything on that investment. But I still made 37%. Okay. 37, I think you said 37.5, whatever. I don't know how I did my math, but 37,500 in savings and taxes. But then over on this side, I made $12.50 a month spread from, and basically what that was, it was the difference between this note that I did at 10.25 and how much I have to pay to my CV line of credit, which is 6% interest. They're going to charge me. Now, if it was your HELOC, it was 8, you might have to do 70 or 75 here, but you just reverse engineer those numbers like I did. And then you come over here, now I'm making that, but plus I still have a full 300,000. It was not diluted. It wasn't 300 minus 150. No, I still have 300,000 earning a dividend crediting rate. And I don't know where I'm at, but let's just guess and just say it's 6%, okay? Because that wouldn't suck. So I'm making 6% plus a spread of $12.50, not much, but it pays for my coffee. And then I got a tax deduction of $37,500. Is that a bad investment? Is that a bad day in the office? Because I think I did pretty good, Michael. Steven, do you think I did pretty good with that?
Yeah, I loved it, man. Thought
It seems like I solved two problems
yeah.
with one bucket of money. But Michael, what do you think this, and I know you can't predict the future, but like if you just went off your past performance, if that 100 grand that I did into, I can't remember what was the drilling investment?
You were probably in drilling program 2 or 3. Right now we're on 4, 5, and 6.
Number 3. So I was in drilling program number 3. So what do you think drilling program number 3 would make at the bare minimum?
Well, I mean, anytime Eckerd decides to propose a well or participate with a $1 billion operator, Class A operator, we target our money back inside of 24 to 36 months. So based off of historical performance, we've returned an average of 33% annualized returns and across over 133 wells in the last 5 years. So that alone, we stand very hard on our track record just because in-house, when you invest with a company like Eckerd, we are a full-time oil and gas operator. We buy tier 1 assets. We work with some of the best operators in the business. Our founder, Troy Eckerd, chairman of the board, he's been in the business for over 4 decades, 40 years specifically in oil and gas alone. And, by participating with the company side by side to Eckerd, you're getting the best deals out there that we can find. And that's why our average return has been about 33%. Now I'll take even a step further. Any of our projects that have delivered cash flow of up to 24 months, we've returned an average of 93%. So, and that's not including the 37% savings right there alone. So in reality, break even on just the investment itself is about 24 months. And if you include that tax deduction in 2 years, you're over 100% ROI. So a lot of investors, specifically at the end of the year where the demand has increased significantly because everyone's trying to figure out where to park their dollars or save some cash, working interest is definitely a highlight in the alternative space for investors such as yourself.
Now, I know I did this one like a month or 2 months ago, I believe it was, but do people still have time if they had 2024 taxes that they'd have to pay and they looked at this and like, wow, I want to do that, but oh man, it's too late. Is it too late now or could they get in by year end?
Yeah, it's not too late because we have available inventory. We actually have 3 offerings. We have a 5 well, a 3 well, and another 3 well becoming available. As long as your funds are in before December 31st, 2025, you can take that deduction this year. If you don't need the write-offs this year, you can always carry them forward indefinitely. And that's why a lot of investors like this asset class as well. I have investors who essentially deploy all their capital, write their income to essentially zero, live off of some of their savings and put their money back to work because of the compounding effect that these returns have. They're significant. It allows you true capital deployment. But aside the deduction, it's more of a deferral because we're just going to give you income in the following years.
Man, I love that. So I got one more thing, and then Michael, I'm just going to turn it over to you folks. Another thing you need to understand is remember, I've got $512.50 that this note is creating. And minerals we'll get into a second. They'd be a good option. That $512 a month is going back into my policies. So how much money every single month when I put $512.50 is in my account? The exact amount. So every month when they pay me this note payment, that money goes into my policy, goes right back into my CV line of credit account, which then credits against my debt. So that money I took out every month, I'm reducing that by $512.50. Okay. But that $512.50 is full liquidity. Like I got full liquidity of that money. I didn't lose access to it because it's just going back to where it came from. So I can constantly just keep regenerating and redoing this over and over. One last thing I did. So, and I want to hit some questions, then we'll turn it to Michael. So my goals were taxes. This was all I needed to hear. I put 100 grand in. I get $37,500 in 2024 that I don't have to give the government. I'm sure Michael and Troy told me, oh yeah, here's our track history and everything else. This is all I heard. And I didn't care about anything else. I'm like, you know what? I want that. But I don't want to have the cost of capital burn down the rest of my cash, which is why I did that second component. And then because I was so happy with how they treated me, and they've got a stellar reputation for treating you like family. I mean, my God, you guys mailed me, what did you guys mail me? You mailed me this big box of stuff with all
Right.
these little goodies. And then just recently, and it's in my office, you sent me a picture, a framed picture that I got on my counter of the well that I invested in. And I get constant emails saying like how excited they are to be working with me. Like they literally treat you really good. But so I went in and I said, you know what? Along with that tax planning, I made a contribution into a SEP IRA. I think it was $67,000 is what my CPA figured out that I had to put into a retirement plan. Now, all of you know I don't like retirement plans. I don't like 401ks, but sometimes it's either I do this or I give the money to the government. But I didn't do a regular SEP. I did a self-directed SEP. So as soon as that money hit, literally days after, I deployed that money into Eckhart again, into another note. Now I could have done minerals, but notes with this note was expiring. And you know what? There's one thing I do know. I've gotten to know Troy well. Troy's never gonna ever default on a note on his building, ever. So I'm like, you know what? Let's do that because minerals, yeah, I mean, maybe there's a little risk in minerals, but the note to Troy, no. Zero risk in my opinion. I'm sure that's not able to be said from a compliance standpoint. I'm waiting for my phone to ring from our compliance officer. You can't say that. All right, great. So there's risk with doing the note, but I know Troy and I didn't think he was going to ever default. So I did that. So I did this. So now I'm making 10.25%. And every month that money is going back into my SEP IRA, creating more money so that next year I can rinse and repeat. So I did 3 transactions with Eckhart. One for tax deductibility, okay, because I needed it. One to cover my cost of capital on my drag, either a HELOC drag or a CV line of credit drag, which is the interest your money costs to use. And then the last one was to keep building my money, to make my money work for me, because there's no way I wanted to leave $67,000 in the custodian, even though my buddy owns the custodian, which is Horizon Trust Company. I didn't want that money sitting in cash. So I gave it to Eckhart to put to work. So Michael, I'm going to shut my mouth and I'm going to let you go through and talk about the fun stuff, but that's what I did, folks. So sometimes you just got to get creative in your thinking. Michael, take it from there.
Well, I'll add on that in terms of strategies, because that's really what it is, right? Is a lot of people don't have the education of the oil and gas industry, but most importantly, it's the investor solutions and strategies that we implement for investors that they really find value, just like the IDCs and the tax deductions that you utilize, or offering great product like the note, paid 1025 monthly 2-year term. But specifically with the self-directed approach, you are aware of the Roth conversion, correct, Chris?
Say that again.
I said, were you aware of also the Roth conversion using the qualified accounts?
Oh, the backdoor, yeah, the backdoor Roth. So I'm
Yeah,
an income earner, so I can't put money in a Roth. So yeah,
well, so the key thing is, like, for example, taking that 67,000 with the self-directed IRA, you can actually acquire minerals as we pivot this conversation, right? So what you also could have done is taken that 67,000, bought minerals, got them appraised by a third-party company. The appraisal, because this is a declining asset, would have written down that cost basis by 70 to 80%. So now when you do that backdoor Roth, instead of paying taxes on 67,000, you would have paid, call that, I want to say $15,000 on that, now going into a tax deferred, tax-free vehicle. So the Roth conversion is huge by investors, just because they're saving significant on the taxes they would pay later when they would use that money in retirement years. And now all that growth from the asset, all that revenue is now tax-free, even when you use it on the back end. So that's a lot of our investors are utilizing qualified monies. But I just wanted to,
next year, I'm going to hold you to this. I got to make a contribution to the SEP next year. So as soon as I have to do that, that's what we're going to do. Please don't let me forget. Put it in my notes in the CRM. That's what we're doing next year.
And the best thing is the taxes you pay, call it the 20%, the 20% of that 67 is then going to be added to your earned income side. And you just match that in a drilling to wash it. Now you're paying 0 taxes. It's a phenomenal strategy. So we'll definitely put that in play for you. But yeah, I mean, I kind of hear the common theme. It's more of the tax deduction, especially end of year. So I mean, when it really comes down to Eckerd, you really had to kind of do your due diligence. One, trust Troy, one, trust the company. And that really comes down to our expertise, right? From there, it's just which asset class fit you best. In this case, it was the minerals because you had the self-directed IRA, and then the tax need, which was the drilling, correct?
Yep. And real
So
quick, can you just back up a little? We got a couple of people asking who's Eckerd Enterprises and what exactly do you guys do? I
yeah,
thought I explained that, but I probably did a terrible job.
yeah, no problem. So Eckerd Enterprises, we're a privately owned energy company backed by private investors like Chris. Troy Eckerd, our founder, he's been in the energy sector for over 40 years. He started his career in 1985. Since then, we've built a phenomenal company. Right now, Eckerd Enterprises, the umbrella company, has three operating legs. On one side, you have Eckerd Energy. We are a full-time operator. We are drilling wells in both the Anadarko, the Permian, and the Williston Basin. So those are the top three prolific oil gas basins in the United States. On the second leg, you have Eckerd Land and Acquisitions, where essentially we're buying oil and gas real estate. We're buying in, again, Oklahoma and Texas, where you have billion-dollar operators exploiting those minerals on our behalf with any additional capital exposure. So essentially, we're the landlord and the oil companies are our lessees, paying us monthly revenue every year. And on the third leg of that is Eckerd Midstream. So Eckerd 2 years ago acquired the second largest pipeline in the Gulf of Mexico, also known as the Gulf of America, because we believe that we are going to be a institutional energy company that in 20-25 years from now, we will be an entity that a company like Exxon, multi-billion dollar company, will look at our assets and maybe decide to buy us out and our partners. So we're not just a tax savings play. We're an investment company, specifically in oil and gas. We combine our expertise with the private backing of investors' capital, and we buy tier one assets in the top producing areas of the United States. So that's Eckerd high level view.
Awesome.
Good there?
Yeah, we're here. Yeah, no, I think that,
Okay.
yeah, I think that answers that question. So I know you were kind of moving on to the second thing. Was there?
Yeah. So, I mean, on top of who we are, next is really the two ways that most of our investors participate in our programs. One is going to be the mineral rights. Essentially, it's more of that safer play, good for qualified monies, creates passive income, true mailbox money. Fun fact, we actually send green envelopes every month. If you decide not to use ACH, we still love that aspect of the business. We target 10 to 12% annualized returns, and the way we're able to do that is because we buy in proven areas where production is proven. We can run comparisons on existing units, existing wells in the areas from different operators and decide, hey, based off of historical data and trends, Exxon will be on this property in a matter of time, a year, year and a half. Because we're the mineral owner, we lease those rights to the operator. The operator then gives us up to 25% of revenue of royalties every month. Once they drill a $10 million well, take those minerals out of the ground and put those to market. Every month before even Exxon can pay their bill, they have to pay us, the mineral owner. So we call it the safest play because it's even above bankruptcy. If a company like Exxon goes under, which doubtful, but a company like it, we've seen a bunch of M&A in the oil and gas industry over the last 2 years. If a company goes under, they have to pay us before they can even pay any type of lien or notes on the business itself. So truly safe play, Class A operators. How would you like to own a property where Occidental, Exxon, Chevron, some of the major operators are paying your rent every month? In our case, those are our tenants. So we like mineral rights. Again, it's all about who, where. Again, Anadarko, Permian Basin, top producing basins in the United States. And then, pivoting from mineral rights, the other opportunities that investors come on board with Eckerd is through drilling, through working interest, like Chris was mentioning. Most investors see the value of the tax deduction up front because of the one big beautiful bill, and because of how Eckerd structures the deal. You can take 100% tax deduction on the investment. So basically writing down your income by that invested unit. So there's huge tax savings on the front end. Aside from that, the returns are a little bit greater because if you think of a pie, 25% of that pie goes to the mineral owner, 75% goes to the working interest owner, which is basically the drilling, the operator, the company. because you are the capital backing, because you are the capital behind the success of drilling those minerals, you get the lion's share of the revenue. And so because we are very disciplined on the areas that we decide to drill these oil and gas minerals, we've returned an average of 33% annualized returns over the last 5 years in across 133 different wells. Now we have a little bit more wind in our sails. We're an actual full-time operator. We have our own rig. So now the deals are even better because we decide when we drill, when we frack and complete, and when we exploit those minerals. Whereas if you participated in a non-op position, like directly with an Exxon, which you can, you have, no choice, no decision, and essentially you're just waiting for them to pretty much do what's best for the company and just hope that they drill a very successful well. So we've kind of taken the reins and have allowed Eckerd to be the decision maker in that aspect. So those are the top two reasons why investors decide to partner with Eckerd. One, they're looking to deploy qualified monies. They have a bunch sitting in their self-directed IRAs, Roth IRA, SEP IRA, solo 401ks. Another strategy in terms of taxes, 1031 exchange. Last year alone, we raised over 90 million in 1031s alone. The reason why they like it is because if they're truly looking to exit traditional real estate, there really is no exit. You have to go to one property to another. With minerals, it allows you to absorb the entirety of the 1031. And now you're in a cash flowing asset from day one that will produce income from anywhere between 50 to 75 plus years. And that's very conservative because you own the mineral rights in perpetuity, all depths from underneath the surface all the way to the core. Doesn't matter if they put 1 well, 2 well, 5 well, 10 wells, you're going to get your fractional share every time. And so those are really the two asset classes at a whole for participating with that. Mineral rights, working interests, and it really just depends on your needs and what you're trying to accomplish. We have the strategies, solutions, and most importantly, we have the product, if you will, in this asset class.
There's so many good questions coming through, and I missed a couple things when I went through mine, and Kevin K was nice enough to do a comment in there, and he hit it, and he said, number one, you earned dividends in the policy. He said, number two, you gained a 37% tax deduction, because I'm in the highest tax bracket. And number three, you earned a spread from the minerals. It was actually a note, but the minerals would have actually given me a higher return. So I would have had a bigger spread with the minerals. So I actually gave you the lower of the two, which actually I didn't realize that. Number four, policy interest equals tax deduction. So one thing I didn't mention in there, and this is important, and this is not going to apply to every one of you, but because I use a CV line of credit through Boosie Bank, that's the bank I use, okay? Not recommending them, just telling you that's who I use. My Boosie Bank CV line of credit is a commercial CV line of credit. It's a commercial loan. So therefore, the interest on that loan, and my CPA set all this up, that interest on that loan is tax deductible. So not only, so it just keeps getting better, and thank you, Kevin, for pointing that out. Now, that's not going to be the case for every one of you, because some of you won't be able to do the commercial line of credit, but I was able to. And then number five, the policy paid down principal velocity of banking. Okay, so I'm using velocity by recycling and recapturing the interest that Eckerd is paying me, which is giving me velocity money, paying the CV line of credit down, meaning the bank, because it's simple interest, is charging interest on a declining balance every month. And the balance is declining not because I'm doing anything different, but because Troy is making a check in a little green envelope to me every month. Although I get the draft. I'm going to go to the checks on the next one. That sounds fun. And then number six, my policy cash value never stopped earning compounding interest. And then he finished with saying anything else. I guess I never really thought about it, but that is pretty freaking cool. If somebody did a webinar for it and I was watching and they did that, I'm like, shit, yeah, I want that. I'm like, how do I get a hold of Michael? Get me started on this. And you know what? That's the thing. We're gonna have to put the link up so people can talk to you there. And one other thing too that I wanted to talk about with Eckerd, and this is a personal thing, is when we first started having Troy and Michael and everybody else come to our events and do this, we did a lot of due diligence. Now again, I'm urging all of you not to just listen to me, because I'm just going to give you our due diligence, but I want all of you to do your own due diligence. have your financial advisors, hire PMC Wealth on a retainer basis to review the investments for you to make sure they're right for you. But we did our due diligence because I've invested in oil a lot of times. Michael, you know this, and I went into this extensively. I've always looked at oil as an incredibly speculative investment. Literally, like a year before I met Eckerd, I did a $300,000 investment into an oil drilling well. I did it just for tax deductibility, so I needed the tax deductions, but I have not gotten a single red cent out of that deal. Not one. I got the tax deductions, but that deal has not paid me a penny. So I've kind of always just had this bad taste in my mouth when it came to oil. I always felt like it was speculative. I felt like every time you're going to invest, you get the tax deductions, which is great, but you're probably not going to make anything on it. But then I met Eckerd and I kind of got in this, and we have Michael. Is Mike on here? Mike Samet? I want to see if Mike can say a couple of things. Mike, yeah, jump on here. I got to have you talk about this. But you know, when I met Eckerd, it was just different. You know, it was family run. That was the first thing. You know, how many years they've been doing this now?
40 years.
They've been doing it for a couple of years, 40 years. So they had some experience, but they kept explaining how they literally don't miss. Like they've got it down to such a science that like every drilling well they do hits. They always, have you ever missed on, he told me there was one deal that didn't perform to expectation. Is that right, Michael? What is the track history over 40 years of Eckerd, or at least?
Yeah. So, I mean, it's funny you say that because the new technology and the idea of a dry hole really went away starting around 2014, 2015, when we started to go horizontal in the zones. So this is a very, very still scratch of the surface industry because it's only about 9-10 years old with newer technology. We're going back to older areas where the idea of a dry hole came from, right? So we're basically going, hey, this was successful and died really fast. What if we tested it and went horizontal? And we're going, holy smokes, we're getting a bunch of oil. That's the industry we have today. So before 2014, the idea of a dry hole and why we were getting such significant tax deductions was because you were probably hitting 60, 70% dry holes. Now, with the newer technology, 3D seismic and everything available for us, it's 99.9% chance we're hitting a very successful well. Now, out of the last 133 wells, the one you were referring to, it was an exploratory well. We were kind of just, you know, we got the at-bat, we got the non-op with a major operator, it was Exxon. You trust Exxon. They were doing exploratory. Why? Because they would rather bring on a non-op partner instead of deploying their own capital. Because if it hits, it hits. If it doesn't, it doesn't. But they didn't lose all their money. So it's performing, it's producing oil, but at such low levels that it's uneconomical. You know, it'll be 40, 50-year payout for us. That's not good enough. We target 24, 36-month break even now today, anytime we participate in a well. And that's why the track record shows what it is. So
love it. All right, I brought Mike on. Mike's been working with you guys longer, and I remember before I invested, I was doing all my due diligence, talking to Troy, doing research, looking at Reddit, just trying to find dirt, right? That's just what we do, right? You do the scratch test, you do the surface test, then you dive deep. And the best thing I knew to do is you just go to somebody that's investing with them. So I went to Mike, and he kind of told me a little bit about his experience. And he says, they treat me like family. Was that not your exact words, Mike?
Yeah, like royalty. You know, a week after the Dallas Money Tank, there was a field trip, Oklahoma City. I mean, he literally treated us like royalty out there. The dinner was like a wedding reception. We went to visit 3 well locations. I mean, wined and dined all the investors. Of course, there's some billionaire investors out there. So well, it was a great experience. And Troy, I call him the Chris Naugle of the oil industry. Relentless work ethic, utmost integrity, fully transparent, passionate, and truly cares about clients and investors. Just a little older than you, Chris. He's like 61. But Troy has never been late on a payment. I can't say that about any other of my investments right now. I have to call, text, email to get my money. But Troy, 25th of every month, the money just shows up.
Did you get those green envelopes, or are you having it direct deposited?
That's direct deposit. The green envelopes go to Horizon Trust. That's kind of what I wanted to talk about with my, you know, I know Michael touched on it earlier, the Roth conversion. So I did all the traditional crap, maxed out my 401k, turned 50, did the catch-up contributions. And when I found out about the infinite banking concept, I stopped contributing and then moved all that over to a self-directed IRA with Horizon Trust. So all great, a lot of money, but it's a tax ticking time bomb. So a way to mitigate my future tax liability, I'm doing exactly what Michael said. So in January, I got an independent appraisal, $100,000 worth of mineral rights came in at $33,639. So then I did the conversion. So I'll be paying tax on $33,639 April of 2026. But yet all the $100,000 is now sitting over there in my Roth, getting royalties every single month. Those are getting the green checks. He mails those to Horizon Trust. So I saved roughly what, $24,000 in taxes. Now there was a slight cost for the independent appraisal, it's maybe $1,600, but I'll be doing this every year, at least $100,000 a year. By the time I turn 75, the government says you have to start taking money out of your qualified account. The RMDs start for me. So again, I'm trying to reduce that future tax liability, but I couldn't be happier with Eckert. Been February will be 2 years with them. I'm all in mineral rights, no working interest yet. That's a little safer in my opinion, but they're all performing beautifully. I'm in 6 mineral rights projects plus the prospector. Question for Michael, there's 3 new mineral rights projects out there, Blacktail, Rockfish, and Armstrong. Which one do you recommend? Should I just buy them all?
I'm going to say buy them all, right, Mike? But I will say if I had to prioritize, take a minimum position in Armstrong, Rockfish, those are Permian plays. Permian has a high barrier of entry. To give you a comparison, right, in the Permian Texas Basin, it's 55,000+ an acre, whereas the Anadarko, it's about $12,000, $15,000 an acre, right? You're getting more zones, more activation. Take an even position because they're bolt-on. It's pretty much one brother sold first, which the Armstrong unit, and then his brother sold, and basically now you're getting a fuller position in a single unit.
Sure.
That's why I would just match that. In terms of the Blacktail, this is
North
in the
Dakota.
North Dakota
Yeah.
Bakken Basin, which is probably a decade ahead in terms of technology of the Anadarko and the Permian Basin. And it's because they have less months to figure things out. They have about 9 to 10 months of production before the whole state freezes over. So they've done that for decades and decades. Troy actually built his wealth in that basin. And out of the last 7 years of attempts to acquire minerals in this basin, we have not been able to get our hands on anything, because if it's not private equity buying it, it's maybe 1 or 2 billionaires that live in that state that are buying every mineral acre. But because of what Eckert has done over the last 5 years in terms of the mineral acquisition side, we've built a reputation with bankers. There were 4 deals at the table. We basically leveraged our reputation and said, hey, we closed with you for $88.5 million. Remember, if you want to do business with us moving forward, do everything you can for the seller to choose us. 24 hours later, we got the bid, and now we have a $55 million package in the Williston Basin. So Mike, buy them all, but if you had to, Bakken for sure, because it's a rare at-bat and opportunity to get some tier 1 assets.
Yeah.
I got to
And
tell
that's
you,
all
Mike.
Troy buys.
Go ahead, Mike.
Oh, I said that's all Troy buys, tier 1 assets. And who knows how long these are going to be available, right?
Now, one thing you just said, Michael, you mentioned Permian Basin, and had I not, I read a lot of books. So when I get interested in an investment, like right now, I'm reading a lot of books on AI because we're implementing AI into all of our workflows. But back when I was really getting deep into oil, like I always read books, and I read this book. I don't know if you ever heard about it. It's called you probably can't see that, The Big Rich by Brian Burrow. In that book, like this book goes back to the early, wildcatters, and it talks so much about the Permian Basin, and it was like the almighty back then. But then they just, everybody was drilling it, and they were hitting dry hole after dry hole, and some of these big oil tycoons of the day were going bankrupt drilling Permian because they couldn't hit it. And so you guys tapped into something good there, and I wouldn't have known that name if I hadn't read this book. So that's how I do a lot of research, folks. I read books about history.
Yeah. Michael, I don't think you mentioned being an accredited investor. Did you mention that at all?
Yes. Oh, no, I did not. But yes, you do have to meet the accreditation status to participate based off of our filing, Reg D, SEC.
Is it a self-accreditation, or is it like a verified accreditation?
No, we don't require any CPA letters or anything. It's pretty much a form. Basically you checking the box so we don't have that liability on our hands. We want to have investors who have I mean, accreditation is whatever nowadays, right? You just could have a couple rental properties and you meet that level, right?
That's
But
super loose now.
yeah, exactly. So the idea is just a level of sophistication. I mean, when it comes down to it, even if you meet that minimum level, you still have to have a certain bandwidth, right? You know, we're right now at an internal meeting setting up 2026 in the next 5 years. Troy just dropped the bomb on us. Our goal is 10 billion in the next 5 years.
Whew.
And actually, Chris, that 1025 note that you took, I'm sitting in the lobby of the building we used to acquire. So when you're
Really?
out here,
That's
we'll have,
pretty sweet looking.
yeah, I was in the golf simulator room, but then some guy started whacking away, and I was like, I don't think I should be in here. But you know, the goal is huge because of the opportunity, and that's what I want investors to understand is you're not you're investing with a true energy company that is looking to build the next Exxon. Like, wrap your head around that, right? You can invest with Exxon now, but through equity paying maybe a 4% dividend, right? Whereas with Eckerd, you're buying ground level and owning the asset directly side by side with us. And I think that's very important because there's no other sponsor in the oil and gas space that offers direct ownership, or at least at Eckerd's level. They're either buying older vertical flipping deals, putting you in blind pool funds, putting you in a fund, GPLP relationship. We don't like those deals. We want true partners, and that's why we do lean heavy on that term. Not in a legal sense, but you know, Mike and Chris, we refer to you guys as partners on the Eckerd side. So
Yeah, you said the accreditation's kind of crap anyway. I feel if that's the case in the stock market, you best in the stock market, you should be accredited because I feel that's a lot more risk than with Eckerd.
Probably one of the riskiest things you can put money in right now.
Yeah.
I know, there's some real estate deals that are, not paying, slow paying. Mike, you and I both know those deals,
Yeah.
and like those are the ones you were talking about. But at the end of the day, we've got the real estate backing it. So like we've got the tangible asset. But the stock market, like, listen, if you put money in the S&P and then, or Nvidia or any of the blue chips, that you're looking at, and those things go down because the market goes down, you got no hope in hell of, like, it's just gone. And then all you've got is like, oh, well, it's just a paper loss. It'll come back. And then it takes you a long time with the drawdown to get back what you lost. Like, I don't know. I have zero money in the stock market. Zero, not a red cent. Outside of treasury bonds, which I guess I should preface that. I got lots of treasury bonds, long dated treasuries, playing that interest rate game. But that's it. I mean, this is what I'm investing in now, and investing in my own companies. That's all I'm doing. And Mike, I'm glad you came on to kind of explain this. And folks, like, if any of you are interested in booking a call, Steven's been doing a good job of putting the link up there. It's right there. Just book a call, get on the phone with them, hear about their different options and opportunities. And we're not, and listen, like, I want to be clear about something. We're not putting this up here or saying, oh, go to them because we get some affiliate kickback. Like, we have a relationship with Eckerd where they sponsor our events, but like, we're not getting kickbacks. So they're here because we believe in them. And that is the only reason they're on this webinar. Because like, the only way you get on this webinar is either you're a friend of ours, we believe in you, or you're paying us. Those are the only three ways on this thing. So those are the ways you do that. There's Michael's email right below that. And Michael, thank you so much for coming on. And Mike, thanks so much. And I know we took you away from Lori's birthday, so tell her we said thank you for that. But is there anything else, Michael, that you wanted to hit before we close this sucker down?
Michael, a couple of people had the question, the minimum is still 50,000 to start?
yeah, 50 for minerals, $100,000 for drilling. On average, it's probably 25,000 a well is, kind of a recommendation. And then for minerals, once you create that account, we then drop the minimum to 25. And this just allows you to kind of acquire them pretty frequent to really build up your portfolio. So yeah.
Wow, that's good to know. So now that I've already got one drilling, I can just do $25,000 increments from here?
Michael, you want to talk about the P2P that's fairly new, the marketplace that you guys just started a few months back?
Yeah, so I mean, we talk about the stock market. A lot of people are in there just because it's liquid, right? The fear of just money sitting there flat. They'd rather put it to work in the market, but they can exit. We found that a lot of investors have kind of been trained, even though we're giving you a cash flowing asset, mailbox money, people will still always ask, what's the exit strategy? Well, why do you want to exit? but we understand things happen. So Eckerd's created what we call the P2P or peer-to-peer marketplace, where investors like Mike and Chris can actually liquidate their mineral positions, put it to the other investors in our network, and allow them to offer fair market price according to what they see value. I'll be honest, there's a lot of sharks in there. So someone might list something for 50K. Someone will throw 5,000 right in there. Obviously that's not enough, but they're always looking for huge spreads there. But it was a way to create liquidity for investors, just so they kind of have that in their back pocket.
Very cool. All right, Michael, thanks so
I'm not
much.
planning on selling, but
Well, it's also good for the buy side. A lot of people up there they haven't had the results yet because activation, right? We're in a low commodity climate right now. Goldman Sachs just came out saying oil is probably going to come down towards, $53 sometime in 2026. That's fine because investors, that's buy side for us. But in terms of returns, it's just delay. But yeah, I was just going to put my phone number here if anyone needs anything as well.
Dell just put a comment in if you want to hit that one before we wrap up. Dell said, are there any best practices to prevent air and water pollution? An avid permaculturalist here wondering if there is any help for the earth, animals, and people that are left in the wake of mining.
I don't know what that means, but everything you kick, touch, use on a daily comes from, single molecule of either oil and gas. So, one way is, unless you're naked and on a dirt road, you're using it. It's just where we're at as not just a economy, but as a culture. It's what we do. But it's a very regulated industry to this point, where we have multiple insurances. We buy in regulatory friendly oil and gas states. Even with the emission traps and all the O2 and all that, we as a private sector has done everything to appease both sides of regulations, whether it's a Democrat or Republican in the White House. We appease both sides. It doesn't matter what they throw at us, because it is what it is. We consume 20 millions of barrel of equivalent of oil a day. We produce 13, so there's a huge deficit. And until we find a solution to offset fossil fuel use, someone said solar in the chat, it's uneconomical. For solar and windmills to be economical for us in an inflationary economy, oil has to be at 145 a barrel. Right now it's at 58, as high as 62 over the last 52-week average. So right now it's the cheapest source of energy globally. So right now we don't have any concerns of fossil fuels going anywhere, not anytime soon, not in the next 50, 60, 70 plus years. But some of these billion-dollar companies that some of our assets are below, like an Exxon, for example, I always refer to them because they're very common. They predict cash flow and run out cash flow models and inventory, not in increments of 5, 10, 15, 20 years, 100 years at a time. They're looking to offset any decline of production for the next 100 years, meaning cash flow, cash flow, cash flow, cash flow. And right now with Eckerd and the backing of investors like Chris and Mike, we're going to position ourselves to break through to become an institutional energy company to essentially compete with the main big boys upstairs. And I think just a little drip for you, Chris, Mike, and maybe some of the other investors on the call, we're actually targeting assets, $200, $300 million companies, to be able to contract maybe 5, 10, 20 plus rigs at a time. So that's big news. That's literally what we're talking about today here at this internal meeting. Everyone coming on at this time, at the very beginning level. We call 1.3 billion assets under management just ground level, because we're going to exponentially grow that over the next 5 years. And we will be a tier 1 asset, tier 1 operating company. And we need all the investors to help us get there. So.
Wow, that's awesome. Congratulations. Tell Troy we said hello.
Will do. Thanks, everyone.
All right. Well, we're going to close this down. There's a couple people that have questions. Diana and John, stick around. We'll answer them after. But with that, Mike, Michael, and Stephen, thank you so very much for your time today. And folks, hopefully you enjoyed this. Just trying to share some of the knowledge we pick up, through wisdom. And wisdom is just time. We kind of go through these things. I know some people are saying, well, what do you do if you don't need tax deductions? You don't have, a policy or a HELOC, that you got the minimums. This may not be a fit for every single person on here, but for those of you this is a fit, hopefully today was helpful. There are lots of other things you can do. For those of you that maybe, you know, don't have chunks of money, but you want to get investing, you want to start doing things, there are a lot of ways you can start saving money on a systematic basis, like a Charles Schwab account. You could just have that money going in every month. You could set up a small policy for a grandchild and be the owner, or, you know, one of your children and be the owner and have lower premium deposits. So there's all sorts of things you can do. But the one thing I'm urging all of you not to do is don't chase returns right now. If someone's offering big returns, it's probably because there's inherent risk. You'll notice Michael didn't talk about big returns. He talked about past history of how these wells have performed. And, you know, listen, like if you go back prior to Trump administration, oil was not doing I mean, oil was high, the price of it was, but it wasn't the flavor of the week. You know, solar was. And solar was something I was looking to invest in because it was great for tax deductibility. But when the tax bill came out, you know, the new tax bill, sometimes you just got to go with the current, right? You can fight against the current, you can swim against the current, you're just going to get tired. So if you go solar right now, that's not the flavor of the week. And I've always said, oil, you know, solar had lots of tax incentives and things and reasons to invest, but it was never, in my opinion, a good long-term investment because it's just flawed at the core. Like solar's a great supplemental, you know, energy, but oil is where it's at right now. That's what powers this country. Yes, I know nuclear is coming on. Trump administration is talking nuclear, which is, you know, especially the new nuclear technology is a cleaner energy, but it just takes so long for these to come on. So listen, like folks, you just got to go with what your heart tells you to invest in. Like we can bring you the things we're doing. And listen, like I know, like some of you are like, I'm never going to invest in oil because it just doesn't fit my box for, you know, just protecting the environment. Well, that's great. Like this isn't your investment, but you find things that you know, like and understand, and you invest in them. So there's something for everybody. Although this may not be it for every single one of you for various different reasons. Every week we bring something new to the table. We do 6 of these webinars. We do Wealth Webinar, Take Back Control Tuesday, oh my God, Stephen, I just butchered yours. I'm just going to call it Monday Fun Day with Stephen Nagy.
Usually, yes.
Money Club Monday. And then we've got the Quick Start that Noah does every Thursday. My brain is fried. But hopefully you guys enjoyed this. Stick around. We'll be back to answer questions right after this.